or you can even call it accommodative monetary policy stance. That's exactly what central bank is adopting at present because of this subdued economic activities. So these economic activities are well below the potential level, full employment level, majorly because of this COVID-19 outbreak. So central bank is adopting an accommodative monetary stance. So you can call it expansion monetary policy stance or monetary relaxation. Monetary relaxation. Then central bank does this accommodative monetary stance by using those tools, right? By using monetary policy instruments. One is open market operation with policy interest rates. So with the expansionary monetary stance, what central bank does is to inject currency by purchasing securities. Right? Central Bank of Sri Lanka purchases government securities from market participants. They are the commercial banks and primary dealers such as perpetual treasuries owned by Aloysius or someone who was involved in that bond scam. Those things happen right here, right? With the open market operation we call it. So in this expansionary monetary policy, what happens is central bank purchases securities. The central bank takes securities and inject currency, inject liquidity to the whole money market, right? Basically, the commercial banks, right? So that is one way of expansionary monetary policy stance. Then the other one is actually these things happen at the same time. You can't, we separately learn it, but they all happen at the same time. So the other method is, as I said, reducing the policy interest rates. Policy interest rates are the interest rates which are adopted by the central bank, right? They consist of a standing deposit facility rate, standing lending facility rate, and even bank rates. Bank rates are not used that much, but standing deposit facility rate and standing lending facility rate are the major policy interest rates, right? So when the central bank reduces policy interest rate, when the central bank decreases policy interest rates, what happens is commercial banks tend to use more of the standing lending facility because it is more advantageous for commercial banks to borrow from the central bank. That means they use more of the standing lending facility due to the lower policy interest rate, right? So that also causes an injection of currency or liquidity from the central bank to the cold money market. That means there will be a flow of liquidity, that means currency, from central bank to the commercial bank, cold money market, right? Then the other method is central bank reducing the statutory reserve ratio. Statutory reserve ratio is the percentage of deposits, right? Percentage of deposits in commercial banks, right? Where the commercial banks have to maintain as a required reserve for liquidity purpose, and withdrawal purpose of the customers, right? Okay. So basically, this statutory reserve is maintained in the central bank, but it is maintained in the bank itself as well. But it is maintained, is kept in the central bank. So when the central bank reduces this statutory reserve, what what commercial banks do is to use more of the statutory reserve and grant loans, lend money by creating deposits, right? So that will also cause a flow of liquidity from the central bank to the interbank or money market, commercial banks, right? So that's the other method, reducing the statutory reserve ratio. In all these three cases, what happens is there will be an injection of liquidity. to call money market. In all these three methods, what happens is there will be an injection of liquidity to call money market, right? So due to this injection of liquidity into the call money market, what will be there in the call money market? Call money market means interbank call money market means what? The commercial banks. The money market within the commercial bank to satisfy their liquidity requirements and liquidity deficiencies. That's it's a what that called very short-term money market, right? Okay. So we call it in single action action, instant, right? Okay. Yeah. So that what happens due to this injection of liquidity, that means currency, so money to the commercial banks. There will be a liquidity surplus. There will be a liquidity surplus in call money market. That means there's an excess liquidity in the call money market. You know, when there's an excess supply, market price falls. Similarly, if there's an excess liquidity, call money interest rate falls. Right? Call money interest rate falls, which we call it average weighted call money rate. So there will be a falling, there will be a decreasing average weighted call money rate due to this excess liquidity in the call money market. So as a result, this average weighted call money rate will reach the lower bound of the interest rate corridor, or you can call it standard rate corridor, interest rate corridor, which is formed by standing lending facility rate and standing deposit facility rate. Standing lending facility rate is the upper bound, standing deposit facility rate is the lower bound. So due to this reduction in average weighted call money rate, it will reach the lower bound of the standing rate corridor or interest rate corridor, right? Then, due to this reduction in call money interest rate, what commercial banks do is to, right, borrow from within the banks, right, even borrow from the central bank, as I said earlier, and grant more loans, lend money to the public. Commercial banks lend money to the public, right, by even creating deposits. So that causes, an expansion in money supply. We learned it in money creation or credit creation as well, right? We learned it in credit creation. Okay, right. Then due to this expansion in money supply, what happens is market interest rate decreases. What happens is market interest rate decreases. When there's an excess supply, always market price decreases. The interest rate is the price of money. Interest rate is the price of money. Right? So when there's an increase in money supply, what happens is market interest rates fall. Commercial banks, the deposit interest rate and lending interest rate both parallelly fall. Right? And when there is a fall in market interest rate, what will happen? What will we do? People will save less, because there's no point saving. People will save less, borrow more, and consume more. People will start, they will purchase lands. They will even construct houses, and they will even purchase more durable items such as vehicles. So consumption increases. And at the same time, investors, they find it is better to do business rather than saving their money. So they save less, they borrow more and start more business. That means they do more investment. As a result, investment increases. So due to this falling interest rates, what happens? Both consumption and investment increases, causing a rise in aggregate demand or aggregate expenditure. Right? This will cause an increase in aggregate expenditure. And then you learned it even in macroeconomic equilibrium. When there's an expansion in aggregate expenditure, output increases multiple times. Output expands. There's a multiplier effect. So output expands due to this increase in aggregate expense. Actually, there's a purpose of this expansion in monetary policy. So, if when the output increases, when the aggregate expenditure, aggregate demand increases, if the economy has already reached the full employment, that means if the real GDP cannot increase any longer, if the aggregate supply cannot increase, that will cause an inflation in the economy. Therefore, central bank will adopt this expansion in monetary policy only when the economy is performing below. Central bank calls it subdued economic activity or subpar economic growth. Like subdued economic activity or subpar economic growth. That means the economy actual output is below the full employment output level or potential output level, which is known as recession. So the central bank will adopt expansion in monetary policy or accommodative monetary stance when the economy is facing a recession. Actually, at the moment, all the economies all over the world are facing a recession because of this COVID-19 problem. That's why all the central banks pump money into the economy. Sri Lanka is also doing that. But there's a limit anyway. If the aggregate supply is unable to increase, the aggregate supply or real GDP is not increasing, is pumping money resulting in an aggregate demand. Causing an increase in aggregate demand will cause an inflation in the economy. There's a limit for that. But anyway, right, expansion and monetary policies are desirable when the economy is in a recession. That means actual output production is well below the full employment level. Then there's a chance for the economy actual output to increase to the full employment level. Okay, that's the point. So this expansion monetary policy will cause an expansion in output, and as a result, therefore this expansion in monetary policies are desirable when the economy is having a recession to overcome the recession. Right? Okay. So that's the whole idea of accommodative monetary policy stance. And we will learn it practically later. This is the theoretical aspect. What I explained is the theoretical aspect of accommodative monetary